afternoon, everybody. Welcome to the TraderMerlin Show. It is your Tuesday edition. We'll do something a little bit different today. I had a question, which is almost kind of a sad question about a house and potentially losing that house. So we'll look at the housing market today because it's one of those things. We look at the data. I can make arguments for bullish moments in it. I can make arguments for bearish moments, but I figure it might be fun just to look at the data as a group. You guys can throw your 2 cents in there and let me know your thoughts on the housing market as we see it. So today is the 27th of June. We are getting to the tail end, halfway through the year. So I hope your first half of the year has been doing great. Kenny from Bismarck, North Dakota. I made a mistake at trivia the other night. I did a round on beer trivia. And of course, I think I may have asked you guys this. Which state sells the most beer or produces the most beer in the United States? And that would be California. And then the second part of that would be, which state produces the least amount of beer in the United States? And I gave a hint to people. I said, it touches Canada, because in my mind, I thought, it was North Dakota. No, it's actually South Dakota produces the least amount of beer in the United States. It's like 20,000 barrels, whereas the California does like 39 million barrels of beer. Anyway, I'm sure you all really want to know that little tidbit of trivia. Let's kick off with the housing market, bullish or bearish. Now, Merlin in leaving Friday? Oh, you're leaving Friday. Well, maybe we can grab a drink. My schedule's pretty. Wednesday might work. Let's dive into first looking at the economic data. I think that's where I want to start with this housing market discussion, because the economic data that came out today painted some interesting pictures. So I'm going to start with the Case-Shiller Composite 20 Home Price Index. Now, for many of you that may not know, this just represents the price increase or decreases in the major 20 metropolitan areas of the United States. So I'll click there. And this chart, as you can see, has been really aggressively sliding. I mean, back in mid-2022, we were up at around 21% year-over-year gains. And that's what this represents, is year-over-year gains of price increases for homes. And notice that for the first time since 2015, we've now ticked down below it. So we've had 2 months where we've been down below zero, meaning price contraction. And that basically says year over year, we have seen a negative 1.7% slide. So while this looks atrocious, what it simply means is prices aren't skyrocketing like they used to, and they're slightly coming down, which I think is to be expected when you have a 30-year fixed rate mortgage go from under 3% to over 7%. That's a pretty big jump. I'm going to scroll back just a little bit on this one so we can see historical data. I'll go back as far as Forex Factory will let me go. And you can see that really the last time we had anything like this was back in July of 2012. So it's been 11 years since we've had a contraction, a decline in home prices, which is good news to many of us who are homeowners. And anybody here who's a homeowner, you're loving it if you've been holding for years, because prices have skyrocketed. And thank you to the cheap, easy money that we had during COVID really helped that. Stimulus checks help as well. So right there, from that perspective, it does paint a little bit of a bearish picture for the housing market, although I'm going to say it's not like atrociously bad. This is simply a pullback in the market. The question really will become, how long and how deep do we get this contraction in housing prices, according to Case-Shiller Composite 20? And how long is that going to last, right? Is this now the beginning of a bigger trend that ends up being something like we saw back in 2007 and 8? Personally, I don't think so. I don't think we're going to get that low. This was a complete meltdown in the mortgage industry and housing market. I think that was a one-off. Do we get something like what happened in 2010 to 2012? That's likely. I think we could see a little bit of a drift down. Maybe we get to that 5% decline mark for home prices, but I don't think it's going to be as extreme as some macroeconomists are forecasting. So right there, you start to see a slightly negative picture for housing. And of course, when I say housing, it's very subjective, because when I look at housing, I'm basing it off of what I know here in my area, which is Orange County. Some of you live in Arizona. Some of you live in Las Vegas. I see North Dakota. I mean, you've got very different housing markets. They're going to have very different pricing structures. Some may have had a huge boom and bust. Some may have barely moved at all, depending on where you live in the country. So this isn't going to be a blanket statement for everybody. It's just the broader theme of what's happening with real estate. So let me go to the second piece of data that was released today. That was the Case-Shiller Composite 20 Home Price Index, which was released 30 minutes before the markets open. Here's the other one, which is the HPI data. And this is really the price increase of homes that were purchased with Fannie Mae and Freddie Mac mortgages. So going the government route. This changes a bit, right? You can see there was a contraction back in September of last year, and we've bounced back pretty quickly. We've had 5 months in a row of gains with regards to the HPI numbers for the last 5 months. So we're at 0.7 right now. The expectation was we're going to stay at 0.5. This actually contradicts the previous chart. This says things are looking rather positive. We're seeing 0.7% gains in the HPI data. So that looks much better. The third piece, which is probably the most interesting one and the one I have the hardest time with, is this new home sales line. It came out 30 minutes into the trading session today. Now, you notice the expectations were that we're going to go from 680,000 new home constructions, or new home sales, to 677. So we're going to drop 3,000. Big deal, no big deal there. Instead of actually declining, it actually increased to 763,000. So that's an increase of 83,000 homes versus a contraction of 3,000. So here's the chart of that. And I'll go back to the same period of time, go back to like say 2000. We were looking at 2007 before, so here's 2007. This has been pretty impressive since those lows of 2009. And I think this is, again, one of the reasons you see the economy doing so well. People have access to cheap money. That entire time, money was really cheap. So we're seeing new home sales surge. Now, I'm of the belief that Toll Brothers and Lennar and KB Homes have incredible employees and economists and scientists, if you will, that are actually checking out all of the major metropolitan areas to find out where to build their homes, how to build those homes, what style. Do you want McMansions? Do you want smaller single-family homes? They're doing all this research, which is way beyond the scope of my level of understanding. And if they're still building this many homes, then they have to have a pretty good idea that the economy and markets are still going to be robust. Now, granted, they're not infallible. They're not perfect. They're going to make mistakes along the way. But I think it's safe to assume that they're probably on the right track. So home builders like KB Homes, let's bring up some of those home builders right now, just take a peek at the charts. Here's KB Homes. Their chart looking pretty impressive. Let me go out to a weekly just so we can see over the years how it's performed, because it did have some choppiness. But since those 2010 lows, KB Homes was at $5. Now it's at $52. We'll take a 10x return in 12 years, not bad. Lennar, right? Similar picture to Lennar. Lennar was at $3, now it's at $125. Incredible move up. Toll Brothers. Toll Brothers really having a crazy bounce from the 2020 lows where it was $13, now it's at $78. So all in all, looking at these charts of home builders, it looks like these are the roaring 20s for home builders. And the numbers today reflect optimism. Obviously, people buying new homes. I've been reading and hearing about a lot of perks and I guess incentives that home builders are giving to people to buy homes, because they knew that the rising rates may have caused some problems, right? And a little bit of trepidation with regards to locking in a longer term mortgage at a higher rate. Hey, we'll give you a tile spa and a hot tub and a metal roof, whatever the incentives might be. There's been a lot of incentives to get these guys to buy new homes, and those numbers look great. So just based off of those three, it doesn't give us a real clear shot as to exactly what's going on, but it does actually look rather healthy, right? I would argue that the Case-Shiller Composite 20 Home Price Index numbers are just reflecting a pullback in market prices. We had an incredible surge, and all of a sudden things dripped down. I'm going to go real quickly and look at the questions that came through here. I see I got a few. What's the true effect of the interest rate hikes versus the surplus of money that's been printed over the last few years? That relationship I don't know, but I mean, it's pretty obvious that the rising rates at some point will start to price people out of homes and the inability to buy a home. If we go and look at the 30-year fixed rate mortgage, I can pull it up from the Fed. Let's see, 30-year mortgage rate. Let's go. I want to find the one from the Federal Reserve. I like that one the best. Seems like the most trustworthy. Of course, now I can't find it. All right. Let's go Fannie Mae and Freddie Mac mortgage rates, just so we can see. So right now, you're looking at a 30-year fixed rate mortgage of 6.67. And if we go back to last, let's say 3 years, because that's been really this big boom, starting in 2021 is really when we saw these the sharp increases. Now, we did tiptoe above 7 for Freddie Mac. That was back in November of last year hit 7.08, and right now, you're at 6.67. So still historically relatively low. However, given the fact you could have gotten them for under 3% back here in 2021, this seems astronomically high. Now the question is, where's it going to go from here? If we look at this chart, I don't really like this chart that much. Let me go and just bring up the trading platform and show you the 10-year, because obviously it's based off the 10-year. Here's your weekly of the 10-year. And I always like to bring this up historically so we can see kind of long-term where it came from and where it might be headed. I doubt we're going to get back to the 1980s when we're up at 16%, but, could we get to 7? Could we get to 8? I think we could. It would be a stretch, but I definitely think that, getting up to 5 or 6 on this 10-year would be no problem. That means if we get to 5 or 6 on the 10-year, then you're looking at, 8 to 10% for your 30-year fixed rate mortgage, and I think that would have a dramatic impact on the markets. Now, let me ask you guys this one, and I'm going to continue to read through some of these questions. And hello, Lisa, hello, Big Eb, and others that joined. What do you think? When we look at the 10-year, right, there's the argument that long end of the yield curve should be higher than the short end. And we don't have that right now. We have that the 1-year and the 2-year notes are actually a much higher yield than the 10-year. That's abnormal. It shouldn't be like that. So, what are some of the things that could fix that? What are some of the things that could bring up that longer term end of the yield curve? Now, here's the problem. Some of you don't want that long end of the yield curve to come up, right? You want it to stay low, because if the 10-year stays at, let's say, 3.7%, then that's going to help the economy and help housing markets. If that yield curve rises from 3.7% on the 10-year to 5%, it starts to constrict the economy. It starts to choke it out a little bit. Cost of capital is higher. Housing market could suffer. What I think you'd ultimately want to see is, instead of having a 10-year raise from 3.7 to 5, you'd love to see that short end of the yield curve go from, 4% down to 0 again, right? Well, that's going to take something like inflation going back to their 2% target, and then they'll start to cut rates a little bit. But, now we have this juggling act of which side of that yield curve is going to end up moving. Here's my thought. Ricardo says, I got lucky at 2.75, but that was a while back. You got lucky, my friend. That's one of those ones, pat yourself on the back and be incredibly excited about that. That's a pretty amazing rate. I refinanced at 287, but I did or 285, but I did a 15-year. So I went a little bit more aggressive because I thought, why not just pay it off earlier? But I could have gotten a 30-year at 2.5. That would have been amazing. Anyway, let's see. What do you think? I'm just curious. Type in the chat what first thing comes to your mind. What are some of the things that you think are going to push that long end of the yield curve higher? A 10-year. What's going to end up pushing that yield curve higher? There's two things in my mind. I'm curious to see if you guys get them as well. It's just kind of fun to have group think going on the show today. So what do you think is going to push this 10-year bond higher? And actually, I keep calling it a bond. It really shouldn't be called a bond. For those that know the naming conventions of interest products, the short end of the paper products, meaning 2 months to 2 years, are called bills. Notes are 2 years, 3 years, 7 years, 5 years, and 10 years. And then bonds themselves are the 20 and 30. So I love this because it's wrong. It says here on TradingView, U.S. government bonds. It actually should say U.S. government notes, just to be precise. All right, I'm waiting for some responses here. Nobody has any thoughts on what's going to impact that 10-year higher, huh? All right, let me read through your question real quick, and then I'll answer my own question that I posed to you. It would be interesting to drill down into the real estate by region. Oh, absolutely would, Tom, but I don't have the time or expertise to do that. I actually have a couple real estate friends. Diana Hill would be my first choice for that. Maybe I will see if I can get her to come on and talk about that, because she always knows the hot spots. And there are tools. OTA had some really cool tools for that, where you could actually see which was the fastest growing, the slowest in the United States. It was like a heat map on it, but that's gone. All right, so Thomasina says inflation. Blue Diesel says credit cards, car note, and student loan mass defaults. And Andy says inflation. Okay, I guess at a high level, we could take inflation and say a high inflation means that they're going to have to continue to raise rates, right? So that's the blanket piece. So number one, we'll say rising rates. Jimmy says foreclosures. foreclosures. Now, would that have an impact to the upside on bond prices or to the downside? Because what it would do, it would drop demand for loans, right? If people start going into foreclosure, that means they can't even make their own payments. They're going to be out of the market and not looking for loans. So I'm not sure foreclosure would have an up impact. I almost think that a foreclosure would start to have a lessening impact because the demand's just not there for, oh, hold on, let me take that back. The less demand means they have to offer higher rates for those bonds. I don't know. That's a tricky one. Sorry, Jimmy. I don't know that one. Sava says, loves. No worries, Sava. Drive carefully. Inflation, I agree. Okay. Here's the second part. So number one is the raising and lowering of interest rates to combat inflation. So yes, you guys are right with inflation, but you have the Fed using interest rates as their tool to control that one. So if inflation keeps rising, they're going to keep raising rates. We'll see this yield curve continue to, at least the long end, continue to go up, and the short end as well. So it'll be inverted for longer. The other piece that I think is critical to understand when we look at that is, what is the Fed doing? Remember, the Fed owns trillions of dollars of notes, bonds, and bills, right? They've been buying trillions of dollars to do what? To support the economy, to make us all feel warm and fuzzy, and to help bail out the economy, which was suffering. So what I pulled up here, this is the Fed's balance sheet as of this moment. And, one of the things that we've noticed is they are selling. They're getting out of their interest portfolio. So I will show you that in just a second. But I want you to notice this part right here. Under notes and bonds, they have right now I'll call it $4.4 trillion worth of bonds and notes. That means that their range from 2-year maturity up to 30-year maturity, they've got $4 trillion. Now, they are definitely unloading a little bit. You're seeing, several million come off this, several hundred million come off a month, right? That's their plan. And let's go real quickly, and I'm going to show you the Fed balance sheet. I want to show you the Fed balance sheet chart just so you can see what that looks like. And let's click that one, and there you go. So part of this issue, I think, is it does not consider the Fed put. Correct. Exactly. The Fed basically not letting the markets fall. Correct, Dave. But you notice what started here. My cursor is off the chart a little bit. Okay. What started really back here in March of 2020, and they telegraphed this. The Fed made it very clear that they're selling off their balance sheet. They're unloading. And it dropped, and then all of a sudden we had a little bit of inflation scare, and it surged back up in March of 2023, but now we're selling off again. Remember, this is the Fed unloading bonds and notes. They're unloading 10 years. So if they unload those 10-year bonds, that means more bonds coming to market. And unless demand increases for those bond products, it means that the Fed is going to have to offer basically going to flood the market with their bonds, and yields are going to rise. I mean, you flood the market with bonds, the yield will rise because there's so much more supply there. It just will end up pushing things up. So when I look at this number here and know that they're actively selling, I look at this as another piece that's going to impact that yield curve to the upside. So it's not just inflation and interest rates. It's the fact that the Fed is now trying to get out of this massive problem that they put themselves in, which is an incredible amount of debt. I mean, they basically hold all this. And again, this wasn't bought with real money. This is bought with synthetic money that was just created on a ledger. Okay, we will pay you this much for these bonds. And the government says, Treasury Department says, okay, great, there you go. So I think that those two factors, your inflation, which ultimately leads to rising rates, is number one. And number two to keep an eye on is how much of this they are selling off, right? How much do they keep flooding the market with bonds? Because as they continue to sell, which is evident here by this chart, that's going to have an impact on the yields. And that could start to spike that long end of the yield curve. Remember, the higher that yield curve goes, the long end, meaning the 10-year, the more challenges it poses for our economy. So that is the other big headwind that I think is facing the markets right now. Sava says, won't that have an inverse effect on what they want to fix? Yeah, it will. And we made this point a while back with not only with Bill Addis, but others that have been on the show. Plus, it's been one of my big drums I've been hitting, is they put themselves in a corner. It's almost that stagflation argument. Like, how do you fix it? The Fed did way too much purchasing. They bought way too many bond products. I don't think they should ever have gotten that deep, right? It had never been done in history, that much of quantitative easing 1, 2, and 3, then Operation Twist, and then all of a sudden COVID just ripping things to the upside. That shouldn't have been done. Now, granted, you and I are probably going, okay, I'm glad they did it because it saved us from a much grimmer time. I think what the economy would have looked like in 2008, 9, and 10 if they didn't do all quantitative easing measures and Operation Twist, it would have been a much more prolonged pain point, but I think we'd be better as we came out of it. Get to COVID. All of a sudden, we went from $4 trillion printed to M1 money supply printed to 20 to I think 21 was the final we peaked out on. So we rallied $17 trillion worth of new money put in. That's going to create problems. So while it was great at the time, it's now created a much bigger problem, I think, that the Fed has to fix. So there's your issue, is how do we get out of this problem? And the Fed's got to unwind their balance sheets, but that could raise the long end of the yield curve, which could hurt the housing market. The Fed could also raise interest rates as they have. I think they're going to hold. I still think they're going to hold at the next meeting in 4 weeks. We'll see how that one goes. But that brings up to this question that I got, and I will see what you guys. Actually, hold on. Before I get to this question, let me go to your questions. There were a couple longer ones here. Real estate by me is just crazy expensive. Housing prices are just going up and up and up. Not much on the market. I'm stuck in my house for a while. Well, you say you're stuck in your house. It's good to be stuck in a house that's going up in value, right? You're like, okay, I like this. It's a good thing. Owen says Sacramento and Elk Grove, California is booming with new homes and prices are steadily going up. Yeah, and also El Dorado Hills, Folsom Lake, that whole area is booming. I was actually debating and looking at Folsom Lake. I found some nice pieces there. Also, people buy whatever they can, so interest rates made me buy a condo at 10%, and a few years later we moved up to a detached home at a low 8%, circa 1990. That's true. And Tom, you're smart enough to buy what you can. I think that the problem we saw in 2008 was a lot of people buying what they wanted and not even thinking about, can I afford this long term, right? Most people that get into real estate do the right thing, which say, what can I afford, right? Yes, I went down to the Wedge a couple weeks ago, and yes, I want that beachfront home that's going for $8 million, and I'm going to buy that. Well, maybe I could in some strange, bizarro world and leverage myself all to hell, but I've also be pushing myself to the absolute limit, right? You find something you're comfortable in, you know that you can make your payments. Should you lose your job for a month or 2 or 3, you're not going to lose your home. That's where we should all be thinking about when we buy a home is this my forever home or an investment? And B, what happens if the worst happens and I can no longer make those payments? So most people have mortgages under 4%. So who wants to sell and pay higher rates? Exactly. That's a big problem. I was debating as well, Big Eb, is I was looking at selling my place and moving out of state, going somewhere else, maybe going back up north with my pops. But just at the rate I'm at, it doesn't make any sense. I'm going to have to buy something new and lock in at a much higher mortgage. No, not going to happen. Excuse me. Let's see. Thomasina says, I think real estate is still hot. A house across the street sold 3 days, and I live in Arkansas. You know what? It's funny, Thomasina. I would say it feels like the housing markets in California are starting to cool a little bit, but other areas where you have very affordable housing, Arkansas, Georgia, Alabama, Tennessee, we're seeing big price surges there because a lot of people that have money are saying, I'm going to go somewhere where I can. If you were here in Orange County, if you found a home for $600,000 in, let's say, Costa Mesa, Newport Beach, Huntington, you find a house for $600,000, it's like a studio condo, and that's about all you're going to get. You're not going to get a 1-bedroom or 2-bedroom or anything like that. You're not going to find anything for $600,000. Whereas if you go to Arkansas, I can buy a 3-bedroom, 2-bath house on 5 acres for $300,000. So someone could go from California where they're stressed on a budget to living like a king in Arkansas. So yeah, it's move to Arkansas. I need friends. I've been through Arkansas. I love Arkansas. It's nice. I don't know. I'm sure I'd have to spend more time there. I wasn't smart. That's all the bank would let us have. Oh, so you were trying to go for more, huh, Tom? Is that near Folsom Prison with Johnny Cash? Yes. Well, it's not right near Folsom Prison. All right, let me see. Stuck at this house, New Jersey taxes. Ooh, Jersey, and my house over 3,000 square feet, so big and empty nester, but no mortgage. Airbnb that thing. Airbnb, Elisa. Rent out the rooms. All right, so let me go to a question here that is a little depressing, and we'll see if we can shed some light on what to do here. And this may be a problem that other people are going to encounter in the near future. So, Armin, thank you for sending this in. I know it's probably tough to say this. He says, I recently lost my job and will be unable to pay my mortgage next month. Would it be best to sell the house or try to hold it? Well, obviously, I can't make that decision for you. What I think you need to do is basically sit out and calculate everything and see. To me, numbers don't lie. That's why I love trading. The numbers don't lie, unless you're Enron. So what I would suggest is sit down and map out the numbers for you. So you say, okay, here's my mortgage payment. I'm sure you're probably going to be actively looking for a job. And okay, maybe you miss your mortgage payment for a month or two. That's not the end of the world. They won't foreclose for a 2 months miss. It's not good for your credit score, but not the end. I would say, okay, and let's just say, I don't know where you live either. I think that's a big factor to it as well. But let's say your mortgage payment is $3,000 a month. Okay, so if it's $3,000, I would make an itemized spreadsheet of all my expenses and say, here's everything I spend money on. I encourage everyone to use an app tracker. I use one called Expense Tracker. I love it. It's a great resource for you. But use Expense Tracker so you know where every single penny is going, right? Just do that for a month straight. You'll have a better understanding of everything you spend money on. Then I would look at, okay, what job might I need to take to cover those expenses? And as I saw Blue Diesel puts in here, roommates. Yeah, I don't know if you got a 3-bedroom, maybe rent out a room, maybe Airbnb it and try to generate some income from that. And if you can find a way to keep the house, personally, I would probably try to keep the home. The other thing you could do is, first off, you got to find yourself some work, right? You're going to have to get to work, find a job somehow. And I don't know what industry you're in here or what, but you could also rent out the home altogether. So depending on where you live, the situation for most people with a home is your mortgage is less than what you could rent that house out for. So let's say you got a $3,000 a month mortgage payment, but you could rent out your house for $4,000 all in. Well, now you have a positive cash flow of $1,000, and you could go move somewhere else, rent an apartment or something much smaller that's, may not be what you want for now. But go as minimal as you can just until you get your feet back on the ground. And maybe a year or two down the road, you kick those tenants out, you move back in your home, and they paid your mortgage for 2 years. So I agree with John. John says sell assets, downgrade the car, get out of other payments. Yep, and that's, again, itemizing all those expenses that you have. Do you want to drive a BMW 300 brand new, or would you rather drive a Toyota Corolla that you paid for cash for and have no payments? May not look as sexy, may not be as as attractive to drive around in an old beat up Toyota Tercel, but it certainly save you a lot of money, at least until you can get your feet back on the ground. And this isn't the end all, right? This isn't that you're gonna be stuck in a smaller apartment for the rest of your life. It's just until you get your feet back on the ground. And unfortunately, as we see this evolution of AI, and I don't know what business or industry you're in, but unfortunately, I think as we see AI progress and more innovation and automation happening, you'll see more layoffs. I think you're going to see more and more of that. So, for anybody who's in an industry that might be threatened by AI, you might already start thinking about it, right? Start watching your expenses, selling off some things that you just don't use or don't need. One of the things I would like to do personally, I have so many things. I'm a hoarder. I'm a collector of stuff. And I have so many things that I haven't touched in over a year. And my thoughts is if you haven't touched them in over a year, you should just get rid of it. One of the things I used to do, one of my favorite things to do, it sounds really stupid, but on January 1st, I'd go through my closet and I'd spin every hanger backwards. So instead of the hook being on the bar, it was behind the bar facing me. And by the end of the year, you'd see which clothes you wore. And if you didn't wear something in a year, you should probably just get rid of it. So I got rid of a lot of clothes. It's funny because you look at something and go, man, I really should wear this more often. But yeah, I think there's a lot of stuff that you could sell that we all probably have in our garages to make yourself a little bit of money. So Armin, that would be my thing. I would try to keep your home. I would try to keep it. I mean, now is not a horrible time to sell. Prices have certainly appreciated a lot. It's just a question of where are you going to go, right? You have to put a roof over your head. And if in your area there's some cheap, affordable rent, great, move into something as cheap as you can get it that's comfortable for you. Right? Don't go into slums, but find something that's not the perfect place. It's going to be something that's going to be affordable, that you can stay in for a year until you get your feet back on the ground, and then make a better plan, and hopefully you'll save a lot of money by then. But sorry you lost your job. I know it's also tough to go through, but you'll make it. You'll be fine. The good news is you actually have a house. So That's better than a lot of people can say. I'll take the BMW. It's a gift. You gotta go to like the Yamava Casino to get that stuff. If you invest in a home, the price has to increase more than 10% mortgage rate, property tax. Given that historical property grows at 2-3%, does it make sense? I think the actual growth rate is closer to 8% for homes. 5 to 8, I think, is the overall long-term growth rate for homes. You needed towing insurance if you're going to drive. Yeah. Yes, my friend Tim knows that all too well. Tim, I hope you're listening right now because he bought a BMW, and I immediately was like, dude, why'd you buy a BMW? It just looks so cool. I'm like, yeah, but you could have bought literally the brand new Toyota Camry, which actually outperformed that model BMW he has, and ultimately he spends so much money on repairs for his BMW. Sorry, bud. Donate to tax write-off. Yeah, John, for Armin, I wouldn't recommend that. So when you say, oh, you mean donate clothes and stuff, I would actually like try to sell it and get the money first to pay down your debt and put yourself in a better situation. That's certainly what I would do. Blue Diesel, that's a really interesting point. I did not think of that. Same with Mark. Mark says lots of retirees are selling their homes and buying an RV to travel. There's a park right behind my house, and there's someone who has a cab over camper, and they're living in that thing right by the park every day. They seem like nice people. I haven't really talked to them. They keep to themselves. They're quiet, but that's something that, again, desperate times call for desperate measures. And what I'd hate to see Armin do is overreact and like panic sell and just take a couple days and collect everything, collect all the data, collect all the info, and say, okay, do I want to rent an apartment for a year? Or hey, maybe I do buy a camper. Not a bad idea. Travel around. If you're unemployed and you can rent out your home and get $1,000 positive cash flow, and then you live in an RV, you can pretty much live for free for traveling around for a while. Trade me an RV and go everywhere. Yeah, I was gonna write a book years ago called The Traveling Trader, and my plan was to buy an RV and trade from that with my dog and document the travels, but that didn't happen. I know a lady decided to sell her shoe collection on eBay. Another site's made 20 grand. Yeah, ladies, how do you spend so much on shoes? Man, I don't get it. Shoes and purses. One of my high school friends, she's an attorney up in Sacramento, and her addiction, gotta give her credit, it is an addiction. Like, she needs Betty Ford Clinic. She could be on an episode of Intervention. Is expensive handbags. Like, she'll post pictures of like, oh, I bought this bag for $4,000. Like, $4 grand for stuff. I go to Costco, or I go to Stater Brothers or Vaughn's grocery store, and for 10 cents, they give me a bag. I can keep your ID and lipstick and all that stuff in there. Jeez. Anyway, Tom says, do we need the Fed? Austrian economics would expect inflation to correct itself. If the habit inflates burger prices and Merlin stops buying, they'll stop. You're right. I'm with you on that. I do think the Austrian School of Economics, the markets will free themselves. However, as a major world economy, whether we're talking US, talking Europe, talking UK, talking Japan, as a major global economy, we are all addicted to the manipulation that our governments provide. If we had a free market where, the high prices of the habit caused me to stop going. I mean, there's certain places, there's a ramen place down the street. I used to love it. It used to be my favorite place to go. Their prices have doubled, and I rarely go there anymore. You're right, a high price. John O'Donnell will tell you, what's the cure for a high price? A higher price. And it'll come to a point where I'm just going to stop buying those goods and services. And I'm maybe the extreme exception because I'm a little bit more thought conscious when it comes to buying things. I'll always go, do I really need this? Is this really worth the money? There used to be a what do you call that? Poke place. There's a food court right by the Online Trading Academy office, and there's a poke restaurant there. It was really good. Line out the door every day. We're talking probably 40 people in line. Crazy business. And then they got greedy and they jacked their prices up and up and up. And I went there a couple months back. There was one person in line. They killed their own business by raising their prices. So you're right. The Austrian School of Economics would say that the markets will fix themselves. However, when you have situations that are created by the Fed, then you need the Fed to fix those problems that they created, right? So for example, we have this super high inflation right now because the Fed just printed so much money and backstopped the bond markets and kept yields incredibly low, flooded the market with cash. Great. It was great while it lasted. But now we're in a situation created by the Federal Reserve that we need the Federal Reserve to fix it. We need them to raise rates aggressively to fight inflation. So I would agree with you. If we could just remove them from the equation, it would probably be better. It would be a new experience, right? We'd have to learn to adapt to not having a Federal Reserve or a central bank system. But I think it would be better in the long haul. Truth be told, who benefits from this? Who benefits the most from this? Is it going to be you and me? Or is it going to be businesses and financial service industries like banks? The answer is, of course, businesses and financial services industries. That's why we have the Fed, because the Fed is made up of members of the banks. So the Fed's going to do things that the banks will benefit from in the long term and make more money off of. It's just simple business feeders is all it is. So it's not going to go away, unfortunately. I wish we would get a movement to abolish the Fed. Yeah, anyway, the soapbox is done. Lost my job at the start of COVID. Been trading ever since. My wife has a decent job and loves me very much, apparently. Good, believable. I'm glad it's working for you. You know, a lot of people struggle when you put the pressure on yourself to generate your income from trading by itself. That gets difficult for a lot of people. Really, a lot of pressure. I struggled when I made it when my sole income was derived from trading. I like having a job just because I feel like I have the security of it, and then I don't touch my trading accounts at all. I'd rather live off a paycheck and live frugally. I don't have an extravagant lifestyle, but then just keep all the trading and compound and compound and compound and compound. Let's see. They doubled the price and suggested, oh man, don't get me started. Where were we at the other day? Like every place wants a tip. Every place wants a tip now. Like you go and you pay for at the gas station, you go inside and pay with your credit card and they spin the little thing around and go, here you go, sir, just sign right here. And it's like 20% tip. Like, dude, you didn't do anything. This isn't full serve. Yeah, this whole tipping thing's getting out of hand. It's driving me crazy. Tell that to the housing market. Mm-hmm. Housing market would not have benefited like it did if it wasn't for the Fed. That's for damn sure. MTB Doc. Hey, Merlin, thanks for the vids. Extremely educational. Have you ever heard of ENVX? I have not. Next generation battery company just got offered a contract with the U.S. Army. Any insights? Thanks again. No, I have not heard of ENVX. Relatively new since 2021. Here's your chart of ENVX. So I don't know much about it. So obviously I couldn't buy it. I'd have to do some research before I even thought about buying it. Hell of a day today. 25% pop to the upside for Enovix Corporation. Great trend since the beginning of the year. I mean, this has been a phenomenal year for it. It's up over 200%. Yeah, I mean, the trend is your friend to the bend at the end. I don't like that it jumped 25% today. I wouldn't have been buying there. I'm not going to be buying on this one, but maybe a little bit of research. I could look and see what some of the competitors are, but I won't do that live. It takes too much time to research those ones. But I just made a note of ENVX, and I'll add to the list. I have some ideas for tomorrow's show. Talk about EV, electric vehicles, obviously the stuff that's going on with Ride and Lucid, and a couple others would be interesting topics. So that's what we'll probably talk about tomorrow. Let's see. Housing is low in supply. When I see a new real estate sign, it says for lease, not for sale. It's funny. We have a house right here in the neighborhood sold for, I think, $1.3 million maybe 4 months ago. And all of a sudden, it's back on the market, but not for sale. It's for lease. And they want $6,800 for a 3-bedroom, 2-bath home. It's just crazy. All right. It's usually the machine that takes credit cards. Some employees are trying to remove it because it makes employees uncomfortable with tipping issues. Yeah, but does a gas station need to have a tip thing on the screen at all? Right? Like, you guys tell me, riddle me this. So I like to go to the Habit. Larry and I make a habit of going to the Habit on Fridays. It's kind of our routine where we catch up for the week. I hope Larry's watching right now. Hello, Larry. If I go to the counter at the Habit, and I buy a burger and it ends up being $13, and they spin that monitor around and it says, are you going to add a tip? Should you tip there? They didn't do anything other than they brought the food to the counter, which is their job. Their job is to make the food. You didn't come out and ask me for water, didn't ask me how I was doing, didn't try to engage in a friendly conversation or be all nice and friendly. Now, I'm not trying to take away money from people, but it just seems like we've gotten kind of absurd with this, where it's like, full service gas station, I'll pay a higher per gallon gas charge for full service, right? That's how it was in the 70s and 80s. Restaurant service, I get it. You're engaging with me. My local watering hole, I always tip very well because they have to listen to me talk. I feel bad for that poor bartender. He's got to listen to me on the weekends. Like, here comes Merlin again. Okay, fine, that's worth a tip. But I don't know. I just feel like for some of the stuff, we shouldn't have to tip, but we're pressured into it. I remember when I first went to Italy, there was no tipping. And I left €1. It was like a $20 meal. I left €1 on the counter. And the waiter, he's like, no. He handed it back to me. I'm like, what? He's no, it's okay. I'm like, no, it's €1. Big deal. Come on, it's okay. Guilt tipping is out of control. Resist. It's tough, man. It's tough. Especially when it's something that does not require any service on their part other than them literally doing their job, which is taking something off the shelf and handing it to me. It's like tipping at a grocery store. You rang up my groceries. Why am I tipping you? Anyway, I'll stop. Let's go into our top 7 and then I'll wrap things up. I went a little bit long-winded on my rants on tipping. Crude oil for the day. No tipping in Japan too. Good. I'm going. Barnder, yep. Exactly, John. That's these bartenders know me. They are my shrink, that's for sure. I tip for service only. Good. No tipping in France either. Oui, I will not tip in France because their service is never so good in France. Don't worry, I'm not going to do the Japanese one. I could get slandered for being mean. Let's see. Businesses are doing that to reduce the amount of money they need to pay employees. Yeah, I could see why. Trend now I've seen is big firms are buying houses and leasing. Oh, yeah, that's another big piece for the housing market, Dwight. Let me just talk about that one real quick. You know, when you look at the housing boom that we've had right now, remember, corporates have been flooded with money. So what you're getting is corporations are buying lots of real estate. I think it's record highs all time for corporations owning real estate, and they'll rent that back out. So, you know, that's another problem is you have people like myself and yourselves who are looking to just buy a single family home for you, and now you're probably having to buy from a corporation who's flipped that home. Market dynamics have certainly changed over the years with regards to that, and I think that's a trend that's probably here to stay for a while until it blows up. All right, let's start at the bottom. Crude oil down 2.41%. You know, we really have not been looking good for the past 3 weeks. I actually called it a month and a half. Really just basically sideways. We're at $68, just below it. You know, I do think you're going to see it drift to those lows. We have this 62.25 line on crude oil. That seems like the logical target for it, just drifting lower, inability to make a new high. So I'm thinking bearish on crude oil. Gold down just slightly today at 0.52% slide. Again, I had this yellow box, which I made the comment on yesterday that we just barely hit it. Well, today we tipped towards it again. If we don't get a bounce, then we'll dip deeper into that yellow box. Today down 0.25% to 1923. Dollar index, slight decline as well. 0.24%. The 10-year, this is obviously in the new session, so we had an update today with regards to the yield for the 10-year, but it's already rolled into the new session, so my numbers are off. S&P 500 was your 4th place finisher. It was almost a clean sweep for indexes to the upside. I actually thought we were going to see more continuation of the downside, thought that negativity would persist and we'd see it go down. Did not even start down. It was pretty much green all day, pushing to the upside. 1.1% gain for the S&P, closing at 44.18. Bitcoin, another surge. It was a nice, there's a comment today or an article that I think Fidelity is now petitioning to have a spot Bitcoin ETF. And again, this is one of those things I'm excited about because it's not like names you've never heard. BlackRock, Fidelity, I mean, they're now two of the biggest names out there saying, hey, we want to have the spot Bitcoin ETF, which tells you it's going to happen. It's pretty certain it can happen, I think by August. Bitcoin's up 1.29%, closing at 30,705. It actually broke above 31,000 briefly today, hit 3,100. Russell 2000 was your silver medal. Nice about face here on the Russell with a big green candle up 1.48% to 1865. Technically, though, still just within that giant yellow box. All right, NASDAQ, which I also was anticipating selling off further. I think the pullback is not done. I do think we need to see it drift down a little bit more to really get a good next surge up in the market. NASDAQ was up 1.72% today. Bummer. I was really looking forward to selling some puts on Tesla today, but they just never came home. I never got close to my price that I wanted for the Tesla. It was pretty much up all day, up 3.8%. Now, what I'll do tomorrow is I'm going to talk about Tesla and Lordstown and Ride and NEO. You know, you had some pretty big moves today, and we'll see if those continue on for tomorrow. But there are definitely some interesting things shaping up in that space, especially with competition being removed, that I think might bolster the argument for Tesla getting a little bit more market dominance. And I'll bring up Tom's calculation on the PE ratio of Tesla based off of going back to the average norm of the auto industry, and we'll see what we think about that. So let me real quickly run through the last couple questions here. Businesses are doing that. Okay, already got that one. Heinz, I'm local pizza and pasta shop. Customers will try and tip me. I will say you never tip the owner, tip the workers. And yeah, right? That's awesome. That's good. Good for you. Minimum wage is $15.50, so no need for tip increases. West Hollywood minimum. Yeah, I don't even go to LA. I've lived down in Orange County for 30 years, and I won't even go to LA unless I have to. I am not a fan of Los Angeles. John says, S&P today, classic example of trade the chart, not what you see, not a bias. Yeah, you know, and again, John, I always like to go into it having an idea. Like, here's what I think is going to happen tomorrow. And I told you, I thought we were going to see a continuation to the downside. Not even close, right? Not even close. I was expecting it to drift, and I actually thought we'd drift down about 43, 41 and have a little hesitation there and maybe a bounce and then challenge that 4,300 mark, but didn't even come close. So, fine. It is what it is. You know, didn't hurt me at all financially today, so I'm fine with that. All right, that's gonna do it for me. I'm targeting that 30-minute show. I'm down to 46, so we're whittling away at the length of shows here just to give myself a little free time to do some other stuff. So hope you guys enjoyed today's show. Armin, do your best, my friend. Let me know how it goes, and there's let me know if you have any other thoughts or need some input and maybe guidance on it. But you're in a tough spot, but it'll get better. They say it's always darkest before the dawn, but I don't think you're in that dark of a spot. Missing a mortgage payment is not the end of the world. Just figure out how to put yourself in a better position. If you realize that, hey, the mortgage payment is just way too much, see about maybe renting out that house, as some of the users had said. Maybe get an RV and travel around for a little bit. I mean, that's definitely roughing it, but you'll save yourself a lot of money. All right, if you guys have comments, questions, feedback, let me know. Send them on in at TraderMerlin@gmail.com, or you can go to the YouTube channel, put your comments below any of the YouTube videos. I will incorporate those into the slides and get those into tomorrow's show, which I'll try to do more on electric vehicles or whatever you guys really want to talk about. So thank you so much. Hit that like button if you enjoyed it. If you're new, hit that subscribe. I'll see you tomorrow. Take care. Actually, before you go, I got a webinar tomorrow. Don't forget my webinar for bar chart.